Good morning, America. Good afternoon, Europe. Good evening, Asia. We're very happy to be back on the OECD tax talks. It's been more than 6 months, I think, that we've been away. So I hope that you're glad to see us back. And if you're not glad, you can turn it off. But we hope that you will not, because we have a good program for you today. I have the team with me. You have the contact there if you want to tweet, if you want to send questions. I will be in charge of the introduction, but I will soon turn to my colleagues. You know Hakim Pros, the head of the International Cooperation and Administration Division, who will brief you on recent developments in his area. We are very happy to welcome Jeff Van Hove, who's working in the Tax Treaty and Transfer Pricing Division, who's bringing new blood to that division and dimension, and he will also touch upon the digital work. Jeff joined the team a couple of months ago, and we're very happy to have him. He will update you on tax treaty and transfer pricing work. We're also delighted to have Melissa de Jong, who's working in Arim's division and who will update you on work being performed there on harmful tax practices and others. And Félicie Bonnet, who is also in the team in charge of the mutual agreement procedures, peer review, and so in that unit working with Sandra. So you will have a broad overview of the work of the Center for Tax Policy and Administration. The topics to be dealt with today, of course, tax and digital, or as I like saying, the tax challenges of the digitalization of the economy. Then we'll move to what has been our core business for the past 2 years, which is BEPS implementation, in particular on minimum standards, but also recent development on transfer pricing. Something was published recently, and Jeff will drive you through that. And we'll also say a few words about tax transparency, the automatic exchange of information, residence and citizenship by investment, and miscellaneous. Just as a reminder, we would like to highlight the work we've done on tax policy, as well as tax inspectors without borders. We did other webcasts dedicated to this topic, so I will just make a reference to that, and then we'll look at the next steps. To start with, on the key developments. Well, the first thing to say, and I think it's pretty big, even though now everybody takes it for granted, is that on the 30th of September, more than 100 countries started automatic exchange of information, i.e. the full implementation of the common reporting standards. Some countries are slightly late, but it has started. It is working. The common transmission system has delivered big information from many countries, including the traditional countries with strict bank secrecy. I think it's fair to say that Singapore, Switzerland were there on time and have delivered on their commitment among many other jurisdictions. So I think that's a big milestone in the history of international tax cooperation. It happened. We also delivered recently to the G20, that was last week in Bali, to the G20 finance ministers, the new work plan for the platform for collaboration on tax. Given all what has happened over the past 10 years in the area of international taxation, we need to make sure, and when I say we, I'm speaking on behalf of the UN, the World Bank, the IMF, the OECD, we need to make sure that we do have a good cooperation, that we don't duplicate, that we join forces to deliver the technical assistance which is needed by all countries, developing countries in particular, to deliver on the domestic resource mobilization, which is part of the Sustainable Development Goals. And of course, the progress on the tax challenges of the digitalization of the economy is the difficult project that we've been working on. And there are some progress. There is some progress made there. And I will immediately move to this part on digital. As you will recall, we delivered in March to the G20 finance ministers the interim report by the Secretary General of the OECD, but this report had been agreed by the task force on the digital economy, and it described, as you will recall, 3 buckets of countries and their reaction to the analysis of the features of the digitalization of the economy, in particular user contribution and its role, behavior reliance on intangible property, and the overall approach to digital. We also had another meeting in July, and there things have been refined and countries have come up with ideas or suggestions. And you have on that slide the ideas, suggestions, which have been put forward by a number of countries. The first one is the emphasis on user contribution. I think it will be no surprise to many people who have read the documents tabled by the UK during their budget, updated just before the release of the March report by the OECD. And it's about user contribution, user participation, the fact that on highly digitalized business model, you would have this role of user contribution, and therefore a need to address this as a contribution to value creation. So that's one idea which has been floated and which is being explored. Also, some other countries, and this could be read in the March report, insisted that you could not really ring-fence the digital economy, that, however, there was indeed a new set of challenges arising from the digitalization, no physical presence, and the fact that the market jurisdictions should, one way or another, get more recognition there, and that addressing the tax challenges of the digitalization should be actually part of a broader approach related to market without much further detail on this, but that was the approach. I think everybody will recognize the US here saying, we're not sure that there is a real necessity to address this, but if you think that there is a need to address the tax challenges of the digitalization of the economy, then it should be a broader approach. And this has been made public a bit later on than July, but in July it was raised in the Task Force on Digital Economy. But for those who follow the news quite accurately, you will have seen that in Vienna, during the informal ECOFIN of the European Union, the German finance minister, followed by the French finance minister, raised the idea of a minimum tax, which could be a way to address what has not been addressed during the BEPS project, and which could deal with the digitalization of the economy. So that's where we are. We had this July meeting. Next meeting is early December. You have the date on the slide, 4 and 5 December, where further discussion will take place. And then we will have probably some form of recommendation, hopefully sense of direction identified by the task force and put forward to the inclusive framework, which is the Committee on Fiscal Affairs in its inclusive framework format, as 119 countries are involved in that work. 119 because last week Dominican Republic joined as a full member this exercise. And in January, the inclusive framework may be in a position to identify either a program of work or a sense of direction or an agreement on what a solution could look like to be further explored technically. And what we hope we will be able to deliver is something more concrete, with hopefully some form of agreement during the Japanese presidency, which starts on the 1st of December 2018, but which will be on in 2019. And there is a big event, which will be the G20 finance ministers meeting in Fukuoka. I think it's on the 8th and 9th of June in 2019, where we may hope to have something consistent related to BEPS, related to the tax challenges of the digitalization of the economy, and some other tax topics. But for the time being, I suggest we focus on BEPS implementation and the 4 minimum standards. Currently, there is the Forum on Harmful Tax Practices, which is meeting, and Hakim and Melissa are the secretariat of this Forum on Harmful Tax Practices. So I suppose there is a coffee break right now because we have Hakim and Melissa. So I will turn immediately to Melissa for her to update you on recent developments in this area, and then she will take a French leave and go back to that group. Melissa.
Thanks, Pascal. That's right, we did just call a coffee break, so we're reporting to you live from the FHTP, where we have, I think, more than 200 delegates from 70 jurisdictions around the world, so we feel very popular indeed. Just by way of recap where we are in BEPS Action 5, this is the one where we have 2 minimum standards for the price of 1, so we have the work on the preferential regimes, as well as a minimum standard for the exchange of information on tax rulings. So I'll just go through both of those and where we are. And what we have on the agenda this week at the FHTP, we have a lot of work to do on the preferential regimes. And so you can see there in the pie chart, this is the results of the work that we've done over the last year or so on the preferential regimes around the world. This will update in a few weeks after this FHTP meeting and when we report to the inclusive framework. So the numbers and the colors in the pie chart will change. But we are seeing an enormous amount of progress. There are laws being changed around the world, and almost on a daily basis we're getting live updates from parliaments around the world where they're changing these preferential regimes. And so, for example, they're making a lot of changes to introduce substantial activities requirements, to address issues with their IP regimes, to introduce the nexus approach. So I really do want to acknowledge the enormous amount of work that's gone on in jurisdictions around the world there. As I said, we will report the results that are in the progress of being discussed this week when we report to the inclusive framework, and you'll have those on our website in the coming weeks or so. So that's where we are on the preferential regime. So as I said, the numbers and the colours will change, but there is an enormous amount of work and progress being made. Just briefly then, if I touch on the other piece of the work that we're doing there, the exchange of information on tax rulings. We've undergone the peer review again this year, covering I think 92 different jurisdictions. What we've identified to date is there's more than 16,000 tax rulings in the scope of this exercise, and almost 21,000 exchanges happened over the course of 2016 and 2017. So we've undertaken a peer review. We will, of course, discuss those this week and release them to the inclusive framework and then publish them later this year. And where we're finding recommendations, we are working hard then to provide additional guidance to jurisdictions, really to make sure that this part of the Action 5 minimum standard works very effectively. The third thing I think that we have on the agenda this week is an ongoing mandate under Action 5 to consider revisions or additions to the criteria and to the FHTP's framework. So we are in a lot of heavy discussions at the moment, and so we don't have anything that we can just release to you right now. I suppose 2 observations on that one. One is really the FHTP lives and dies by the level playing field. So any of the issues that we're considering is really about making sure in the context of tax competition that there is a level playing field. And I think my other observation on this one is that this is where I believe that the policy outcomes are in fact better and more robust because we have the membership of the inclusive framework. So it's been a really important part of the work, and we do hope to be able to report more on that later this year or early next year. So that's all I had on Action 5, so back to you. Thank you.
Thank you, Melissa. So you're free and you can go back to work now. And thanks for the very live and on-time update. I will now turn to Jeff for him to brief you on where we stand on the multilateral instrument. It's one of the big deliverables of the BEPS action plan, and it's important to know where we stand. So Jeff, please. Microphone.
Thank you, Pascal. I'm going to, as Pascal mentioned, provide an update on the multilateral instrument process. The first point to make is that we currently have 84 jurisdictions that are covered by the MLI. By that, I mean that 84 jurisdictions have effectively signed an instrument. 15 of those 84 jurisdictions have taken the process farther and have ratified the MLI pursuant to their domestic rules and have deposited with the OECD their instrument of ratification. As a result of the efforts of the 84 jurisdictions, we have over 1,400 bilateral tax treaties that have been matched. Now, what we mean by that is that with respect to those 1,400 tax treaties, both parties to the treaty have signed the MLI, and also listed that particular treaty as a covered tax agreement. In addition to those 1,400 fully matched agreements, we have another 1,000 that are waiting for a match. And by that I mean that with respect to those 1,000 agreements, at least one party to the contract has executed the MLI and listed that treaty as a covered tax agreement, but not yet both parties. I think the key takeaway here is that we have 1,400 matched agreements already, but we expect that number to go up substantially over the coming months. I think it's appropriate when thinking about the status of the MLI to take a step back and reconsider its underlying purpose and what we're seeing in terms of results. The MLI, of course, is a vehicle that enables countries to efficiently implement the treaty-related measures developed during the BEPS project. One of the critical treaty-related measures is reflected in Action 6 and its minimum standard designed to prevent tax treaty abuse. What we've seen is that in each of the 1,400 matched agreements, both parties have elected to satisfy the minimum standard by adding the necessary language to the preamble, as well as adding to the treaty a principal purpose test. So we're seeing significant take-up in the MLI as a vehicle for implementing the Action 6 minimum standard. We're also seeing in the results of the MLI developments that countries are using it to update their mutual agreement procedure provisions as part of their efforts to comply with that minimum standard, the Action 14 minimum standard. And finally, I wanted to note that of the 84 covered jurisdictions, 28 of them have opted for arbitration, a topic I'll come back to in a subsequent slide. So where are we in terms of entry into force of the multilateral instrument? This slide demonstrates that the MLI entered into force for the first time once the first 5 jurisdictions deposited with the OECD their instruments of ratification. That happened earlier this year, and so the MLI itself entered into force as of July 1st. Since that time, we've seen an additional 10 jurisdictions complete their ratification process and deposit their instrument of ratification with us. We expect, of course, more jurisdictions to do so by the end of the year and in the coming months. I think we expect that 47 agreements will be modified by the MLI. The MLI will go into effect for 47 agreements as of the first of the year. And maybe just taking a step back, in terms of what this entry into force slide means for a particular covered tax agreement, it's important to bear in mind that covered tax agreements will not be amended or revised until both jurisdictions that are a party to that treaty have ratified the MLI and it enters into effect for them. With respect to arbitration, as I mentioned before, 28 jurisdictions have opted for arbitration. There are 2 types of arbitration that are contemplated by the MLI. One type is final offer, or baseball arbitration, and that's a process by which the 2 competent authorities each present coherent proposals for the resolution of the dispute, and the arbitrator picks one. The other process for arbitration is the so-called independent opinion option, and there the arbitrator doesn't simply pick between the options available to it, but rather explores the facts and the law and comes to its own reasoned decision. It is our expectation that as these countries and others continue to have more experience with arbitration, more and more jurisdictions will adopt arbitration to improve their dispute resolution procedures. Final topic that's closely related to the MLI relates to Action 6 peer review report. We're currently in the process of completing the first annual peer review report for Action 6. That process consists of a number of phases. The first phase, which has been completed, is a period of self-assessment by the countries, pursuant to which they fill out a questionnaire, articulate how the agreements fare under, as they're currently drafted, under the minimum standard, whether they've signed the MLI, and so on. The next phase of the process is the one we're currently in, which is we're preparing the report itself. We're currently working with Working Party 1 delegates on the language of the report and hope to finalize it in December. Once the report is finalized, it will be presented to the January meeting of the CFA Inclusive Framework. Last point there on this slide is that these peer review reports will be an annual process. And so we're working on the 2018 report, and we'll do reports in the future to continue to review how countries are doing in terms of implementing the Action 6 minimum standard.
Thank you, Jeff, and for the update. This report on treaty abuse, I think, will be quite interesting when it's out. We've recognized that it's a staged approach, that it takes time for countries to change their treaties, but what we can see, and you will read that in the report, is that changes are happening fast there, thanks to the MLI. And even though it doesn't show as such in the report itself, but we can say with confidence that treaty shopping hubs have signed the MLI, have now nominated all their treaty partners, and that treaty shopping, as we used to know it, is coming to an end, which I think is good news. The other minimum standard, which has attracted a lot of interest and excitement from civil society, but from businesses also, who had to do the work of filing this country-by-country reporting, is the CBCR. And I will turn to Hakim to update us on where we are on the implementation of this minimum standard. Hakim.
Yes, so we're moving to Action 13, the country-by-country reporting, as Pascal has said, for many businesses, not a terribly popular sport, but something, as you can see, that is now taking shape in very concrete ways. So let me tell you where we are in the implementation, and then let me spend at least a couple of minutes on where next, where some of the things that will be happening, that are about to happen, where they're going to go, and what is going to happen. So starting first with the implementation, where are we? Domestic law. In a nutshell, CBCR has been implemented around the world. So as it says here, 70 jurisdictions have implemented a CBCR filing obligation, if you include everyone, including those that have implemented for years after 2016. So if you translate and what does this mean? It means that substantially all M&Es that are above the threshold of 750, which is where it comes in, are in, and that means that's estimated to represent 90% of the corporate tax base. So the corporate tax base globally is in the system and is being reported in the jurisdiction where the parent entity of the M&E sits. So that's the first step. So that's the collection of the information. And then we go to the next step. That's good, but am I also receiving this information if the parent is not in my country? And the answer is yes. That's the part about the exchanges. This information is being exchanged. As you can see on the slide, we now have 1,800 plus exchange relationships that have been activated. That's through the multilateral instrument that we have developed, which is a multilateral instrument for bilateral exchanges that can be done, or it can be done through bilateral qualifying competent authority agreements. Quite a mouthful. So for instance, the US with 41 of these. We've had the first exchange, so exchanges have happened. The first exchange deadline was the 30th of June, and it did happen. There were some technical issues, initially teething questions, but they have been largely resolved. So now we have the collection of the information, and we have the exchange of the information, which tax administrations now have, which brings us to today. And so now the information is in, and the question is, so now what? First of all, and these are sort of the next steps, and in some sense they're not just next steps, they're present steps, is the first one. CbC information is for high-level risk assessment. So what we're doing now is that we work together with a whole bunch of tax administrations, but also businesses, to work out specifically and together the most effective way of making use of this information. So we're very grateful, for instance, that in September, China SAT hosted a workshop with 21 countries, 10 representatives of business, BIAC present, to do exactly that. How is it working? What can we see? How can we improve it? What learning is in it? There will be more work for the tax administrations that come together. We have a handbook, as you know. We'll update the handbook to provide the intelligent, the learning of one country to another country so that collectively they can make the best use of risk assessment of the information that's coming in. We're also trying to help developing countries with a template that facilitates their understanding of what this information actually means in a wider initiative also embedded in capacity building for transfer pricing. And last, and sometimes referred to the sunny side of BEPS if you wish, that's the work that we're doing through the large business network, which is kind of taking this information and having a collective process with several tax administration, with business, and trying to see whether we can take this risk assessment also to provide forms of de facto early certainty through our risk assessment initiative and things such as ICAP. Let me then take you to the other things that are happening in the CbC space. I already mentioned developing countries. I think that's a very important part, that you actually enable developing countries to make use of that. So we have a program where we work across the CTPA to enable them to make better use. They need to have the capacity, they need to have the transfer pricing skills, they need to have the exchange instruments. So we have something where we try to be holistic to enable them to take advantage of this. So there's a big piece. The third one to mention here in the CbC is, of course, there is a 2020 review, and the review thinking for the 20 review will be commencing in 2018. As you know, CbC, it does refer to a 2020 review. If we want to get there in 2020, then we will be starting the reflections on this now, and we will be seeking input from stakeholders, including business, on this, of course, as we move forward. Let me then finish with the last 2 points in the wider world of country-by-country reporting. One, there is a peer review. We've done the first one. We've issued it in May. It covers 95 jurisdictions. It's a big book. Don't print it out. We'll do another one which will focus on a phased approach on the domestic law implementation. Have you addressed the recommendations? We look at the exchange framework, on the timeline for the exchanges, and very importantly also to ensure that countries are making appropriate use of the CbC reports for high-level risk assessment for transfer pricing, other BEPS-related lists. The last piece, important also in the CbC space, we will also be releasing aggregated and anonymized CbC data will be included in the corporate tax statistics data set from 2019. That, I think, wraps up the review on where we are in the wider land of country-by-country reporting.
Thanks for the update on Wonderland. And I'm not sure it's Wonderland when we talk about mutual agreement procedure. At least taxpayers would say that it's not Wonderland at all. So I'll turn to Félicie for letting us know what's happening on that front. Please, Félicie.
Thank you. So I will go through the last works we've done on the mutual agreement procedure and with respect to the BEPS Action 14. First, I will describe the status of the works that we've done and go through the highlights of the reports that were published this year, and then we'll turn to the 2017 MAP statistics that were released last week. So as regard the schedule that you can see, I will not go through the whole schedule, but the key message I would like to deliver here is that the 7th batch is going to come very shortly. We are going to launch this batch by the end of the year, which means that, as always, we are going to invite taxpayers to provide input beforehand, and this will mean that if you have any experience to share with any of the jurisdictions that are in orange on the calendar that you can see, please share them with us. The deadline for doing so will be by the middle of December, so you still have some time, but we are usually facing a kind of lack of taxpayer input, especially for the most recent batches. So if you have any experience, please share them with us. Something also that we don't see on the slide here is that we have a schedule for the launching of the stage 1 reviews, but we are also doing a stage 2 review, which means that after 1 year after adopting the stage 1 report of each jurisdiction, we are following up the recommendations that were made in stage 1, and stage 2 has already been launched for the first 2 batches. As regards the reports that were published this year for batches 3 and 4, you can see here the main areas we are focusing on and any circumstances that may have affected the reviews that we have performed. Again, I will not go through what is on the slides, but just draw your attention to the fact that there have been an area of concern with respect to the interaction of domestic time limits with 2 key areas of the MAP, which are access to MAP and implementation of MAP agreements, because we have seen in the jurisdictions that have been reviewed that domestic time limits may actually affect the access to MAP to eligible cases and may also affect the implementation of MAP agreements. Turning to the 2017 MAP statistics, what is really new for this year is that for the first time, jurisdiction by jurisdiction statistics are published, which means that for each jurisdiction, we are able to see who are its main MAP partners and with whom it has the more MAP cases and how it is going to resolve them. This is completely new and it will increase transparency because for each jurisdiction you can also identify whether a kind of outcomes or a kind of time frame is different depending on its own MAP partners. What we have seen in the statistics is that the number of cases that started have increased compared to 2016, and this is due to an increase of public awareness about mutual agreement procedures and also to new accounting rules. We have also seen that the number of cases closed have increased significantly as well, although to a lesser extent and especially for other cases. This being said, even though there is an increase in the number of cases started and number of cases closed, you may have noticed by looking at the website that sometimes the global inventory seems to have decreased, and this is because now, thanks to the publication and the reporting of jurisdiction by jurisdiction statistics, we are able to reconcile the numbers and identify the cases that 2 jurisdictions have in common, which means that we are able to eliminate the double counting of these cases when we are assessing how many cases there are in total. Turning to the cases that were closed in 2017, what we can see here on our pie graph is that around 80% of the cases were closed with resolving the issue at stake, either in the unilateral phase for 20% of them or during the bilateral phase for more than 55% of them. And just to have in mind that these outcomes may be a little bit different from one type of cases to the other, because for transfer pricing cases, more cases are closed during the bilateral phase, while for other cases, there are more cases closed at the level of the unilateral phase. Regarding the time frame to close MAP cases, on average, the time frames remain exactly the same as for 2016 MAP statistics, which still shows that transfer pricing cases take more time to close than other cases. And to finish with a positive note, just let me tell you that 60% of the reporting jurisdiction that closed cases in 2017 have actually done so, meeting the average time frame of 24 months. So it means that they closed cases in less than 24 months.
Thank you, Félicie. We know that sometimes good news are not well taken by taxpayers who are not on the average, but who are above the average. And when you face a case for 5-6 years, sometimes more than that, the fact that 60% of the cases would be closed within the time frame is not necessarily good news for you. So we fully understand the frustration there, but I think it's fair to say that tax administrations are investing in the elimination of double taxation. The fact that Action 14 was a minimum standard is a game changer, and we count on you to be able to feed the process, to feed us, including on an anonymous basis, as we indicated. If you need to share your concern, you're welcome, so please use this. The BEPS package did not include only the minimum standards, but many other measures, and there was some remaining work to be done on financial transactions within the area of transfer pricing, and that's why I'm going to turn again to Jeff for him to brief us on the on this work on financial transactions. Jeff.
Thank you, Pascal. So, to set the table and to start with a bit of context, as Pascal mentioned, the BEPS final reports contemplated a series of additional items of guidance related to transfer pricing. One of those items was the attribution of profits to permanent establishments, and that item of guidance was published in final form in March of 2018. Two additional items of guidance included the guidance on the transactional profit split method and guidance to tax administrations on hard-to-value intangibles. Both of those items were published in final form in June of this year. A fourth follow-on transfer pricing project relates to financial transactions. And with respect to this project, we have published a non-consensus discussion draft in July. The financial transactions project, I think, can be seen as being qualitatively more challenging than the other transfer pricing guidance projects we've worked on in the wake of the BEPS project. What we're finding is an element of difficulty in achieving consensus on some fundamental issues. One example of a fundamental space where there are disagreements among the members of the working party working on the guidance is the role of the arm's length principle in evaluating capital structures. In light of some of these difficulties in achieving consensus, we chose to publish a non-consensus discussion draft to elicit public feedback on the topics we are discussing and to gain more insight and information about them. The non-consensus discussion draft can be thought of as consisting of two components. Its first component focuses on existing transfer pricing rules related to the accurate delineation of the actual transaction and tries to apply those existing rules to the particularities of financial transactions. The second component of the guidance is focused more on core pricing matters and addresses such topics as cash pooling, the provision of guarantees, captive insurance, hedging, and intergroup loans. The response from the public on the discussion draft has been robust, to say the least. We've had approximately 80 parties submit comments, and in the aggregate, it's about 1,000 pages of comments. We've heard from particular taxpayers, professional organizations, and industry groups of a wide variety. What we're hoping to do is, as we digest the comments that we've received, we're hoping to leverage those additional insights and information to further inform our efforts to try to find consensus with the working party members and eventually proceed to publication. I would like to thank all the members of the public who did provide the comments because they are proving to be very helpful. But on this one, for sure, there's more to come.
Thanks, Jeff. And please stay tuned on that work. Let me move quickly to tax transparency with a quick update on exchange of information. As I told you, automatic exchange of information has started with more than 100 countries successfully, which I think is a very important step. This will be taken into account in the exercise that the G20 mandated the OECD for, which is about identifying countries not complying with their own commitments. That's the listing process. As regards automatic exchange of information, it's good that it started. It's better that it's being reviewed, and the Global Forum is designed to review countries. So to review a country, and all the other members of the Global Forum, what you need are terms of reference on the one hand, and then a methodology on the other hand. We have agreed or are in the process of agreeing terms of reference, which will be discussed at the next meeting of the Global Forum, which will take place in Punta del Este in Uruguay on the 20 to 22nd of November. And the methodology will also be developed to know what is going to be reviewed in 2019 and what is going to be reviewed next. And it's not an easy thing to design the methodology for automatic exchange of information, so that will be a big task of the Global Forum. And be aware that back to the Global Forum meeting, there will be a LAC, Latin American and Caribbean Ministerial meeting to deal with transparency, digital, and the broader international tax agenda. So something to pay attention in the coming weeks. But one from the print, we have issued today a press communique dealing with some challenges to the Common Reporting Standard, in particular what we call RBI and CBI, Residence by Investment and Citizenship by Investment. On this latest news, Hakim, could you please update us?
I'd be happy to. So what have we done here today? Earlier you will have seen we issued a news release with documentation, background, guidance, and next steps on what? On the growing number of countries that offer citizenship or resident by investment schemes, sometimes also referred as golden visas. Now, there's many issues and questions around those, so we need to be very clear about what this is and what this serves. So the idea here is to look at the integrity of the Common Reporting Standard and identify schemes that can pose a risk to the integrity of the Common Reporting Standard. What does it mean? It means that perhaps in connection with obtaining such a resident by investment, identification document, residence permits, and other documentation may be obtained, which will then be used in opening accounts with financial institutions and may in fact conceal a secondary, a primary, the real, if you wish, residence, so that the reporting goes to the wrong country. So that is the risk, and that is the risk that we're seeking to address here. So we've analyzed over 100 of these schemes that are offered by jurisdiction that have committed to the CRS, and we have identified high-risk schemes by country, which you can find in what we have released today, and related guidance to financial institutions. First question, what is a high-risk scheme? And this is what we're trying to explain here. It's effectively a scheme whereby the person availing him or herself of the scheme, on the one hand, will be taxed relatively lightly on income on foreign financial assets, because they're exempt, because it's territorial, because of whatever features of that country's law, and the schemes do not require a significant physical presence, making it relatively easy to still have another, if you wish, primary real residence where no reporting then happens. Importantly also, as we say on the last point here on the slide, we've also considered as a risk mitigating factor, as a result of which you will then not be identified as part of a high-risk scheme, if the country has committed and does undertake to spontaneously exchange information on the scheme, the taxpayer in the scheme, with the country of original tax residence, so that they are aware that there is this potential risk. What does it mean in practice then? It means that financial institutions are meant to be equipped to deal with these cases, which is why it is something that helps in the due diligence process. Financial institutions do operate under the CRS on the basis of a self-certification procedure, but there is an obligation to ensure that the information is reliable. And when they're now coming across of account holders from any of those countries identified, as part of that process of ascertaining as to whether the documentation is reliable, there's a number of questions. So it's the feature of due diligence that I think we are highlighting and we are improving. Going forward also, this is a dynamic list. There may be others that may be added to this assessment of high risk. And we will also be looking to jurisdictions that are outside the jurisdiction that have committed to the CRS standard. Importantly, again, the regime is a high risk, but it still needs to be used. In that sense, you need to understand the context within which those regimes have been identified. Give it back to Pascal.
Thank you, Akim. So we hope that this clarification today will help make sure that people don't abuse of these opportunities or schemes, and that the CRS integrity will not be threatened by these. Quickly on miscellaneous also, I would like to draw your attention to tax policy reforms 2018 that we issued a few weeks ago. For those interested in tax policy, we did a webcast, and there should be somewhere a link to that webcast if you want to replay it. The findings, very quickly, some cuts on personal income tax. That's on a sample of countries which have passed significant tax reform for low and middle income earners. Interestingly, we can see that the trend towards decreasing the rates of corporate income tax can be described as a race to the average rather than a race to the bottom. At least this is what we've seen. And of course, the US tax reform, I think, is a good illustration, with the US now having a tax rate on average, including the state level, of 25%, which is precisely the OECD average. And the fact that the rates on VAT, which had increased tremendously after the financial crisis, have now stabilized, but the revenue coming from VAT has increased because of anti-abuse measures and administrative measures, including, by the way, the changes introduced by the BEPS action plan on how to ensure that digital services or the sale of digital goods would be taxed at destination. We could also, and we can also see a trend towards excise duties on goods, consumption goods, which can be harmful to health also, drinks on sugar in particular, and environmentally friendly taxes, which still grow, in particular as regards the use of vehicles, even though when you look at the overall carbon pricing, you could have questions on whether this is the right level. So if you're interested in that work, which I think is extremely important to understand the world we live on and the trends, please have a look. The other area where we recently did a webcast, I think it was last week or the week before last, is on tax inspectors without borders, which is one of the initiatives on tax and development. It's quite an interesting one. It's a niche. It's very special. It deals with matching the demand from developing countries or emerging economies to have skilled tax inspectors to do a real-time audit with the local team and with the assistance of a skilled tax inspector from a more advanced country. This initiative has yielded so far more than 400 million of revenue collected by the countries which have used the initiative. The OECD and the UNDP are the platform where we organize that matching. We also find the funding for these deployments. We have currently more than 30 programs going on. The target is 100 deployments by 2020. And if you are interested in that, please go and watch the webcast where you have the link on that slide. More to come on tax inspectors without borders. We issued the annual report 2017-18, but I think in the coming months this initiative will participate to a few events, the Paris Peace Forum in particular on the 11th and 12th of November this year. It will feature as one of the events for this Peace Forum. We're coming to an end to this webcast, just identifying the next steps. The G20 Leaders Summit, where tax will be on the agenda on 30th November and 1st December. Then the Inclusive Framework, the Committee on Fiscal Affairs in its inclusive framework format at the end of January, And during the year 2019, the French G7 presidency, we understand that there may be a push for some of the items we refer to, minimum tax, for instance, or the Japanese presidency of the G20, which may take stock of where we are, past, present, and future of the BEPS work and the transparency work. It's time, and we're slightly late for the questions, but I'm relaxed because we have not received so far any question in live, but we had a few questions not only prepared by us, but sent by some of you. So I would turn first on the CBCR to Akim, reading the question. Now that CbC reporting has started, when do you expect to have collected enough data to do a new assessment of the cost of best practices and the effects of the BEPS being implemented? I'm not sure it's for you or for David Bradbury, who's not for us today. But Akim, do you want to say a few words of what's going to happen in terms of collection of this information? And then I may explain what we're going to do with this.
I think there's certainly, and maybe more, but there's two dimensions to this question. There's the first dimension about now that the information is with the tax administration, what do the tax administration actually do, and what do we do with the tax administration as they look at this information? And there's a lot of work, which I tried to explain before on the CbC update, work to better align, synchronize, as you wish, coordinate, better understand the risk assessment processes of different countries. You know, this is on transfer pricing. This is things that OECD and the wider world has agreed, and permanent establishment, other risks that we have. How do we make sense of this in a world where both, and this is one of those maybe where win-win is appropriate, where actually there is an interest in tax administration to minimize the instances where they go for what is an expensive audit type intervention. And at the same time, there's a benefit for taxpayers that want to be in a compliance space to also have early certainty on their risk exposure with respect to the reserves, whatever this means. So there's a couple of dimensions that are coming together that help us in this process moving forward of trying to understand, to better understand, to work together domestically, bilaterally, but also multilaterally in these risk assessment processes where we will work with business. So that's, I think, step one of the risk assessment side. There is then the second side when we look at the information, in particular, I guess, the aggregate information, and kind of say, okay, well, what are we seeing? How are we seeing the change? That's the Action 11 dimension, where, as I've said, we will be releasing aggregated, anonymized data, I think, in 2019 on CbC, drawing conclusions. What those conclusions are, I hand it back to Pascal.
Thank you, Akim. I'm happy to confirm that in June 2019 in Fukuoka for the G20 Finance Ministers meeting, we will be able to deliver the aggregate data and some analysis of it, which I think will be extremely interesting for all the observers. We have a question on MAP, and the question relates actually to denied access to MAP. What's the source of these data? And the person who asked the question, who focuses on Asia, and said, this is a big problem in Asia. How can we make sure that you have all the information and that your statistics reflect the reality? So, Félicie, how do we handle that?
So the source of data is the jurisdiction itself. So the jurisdiction itself prepares its own statistics that it reports to us and that we are publishing. For all the new cases that started after 2016, this is reconciled with the data that the treaty partner may have on the same cases. Of course, it may be that the taxpayer only went to one country and did not submit its case to the other treaty partner. And in that case, that's exactly what we would like to see reflected in a taxpayer input, because the peers cannot have any information on that, but the taxpayers may know about it. And then we need to take that into account for the review of the implementation of the Action 14 minimum standard. And we are definitely interested in getting the taxpayers' experience on that.
Thank you, Félicie. we are short of questions, which makes us, I mean, happy or worried. So I've checked how many of you are live right now watching us, and it's a pretty good number. I mean, we're talking about hundreds, 200, with 600 people registered, and we're talking about single viewers. And we know that sometimes you take the opportunity of the webcast to gather with some colleagues and maybe have some drinks while listening to us. So be light on the drinks and heavier on the questions. So I just have one more question that I received from Germany, which is about the idea of a working group which would combine reporting and combine CbCR, I suppose, and firm reapportionment to downsize the gap between the very rich and the rest of mankind. I'm not sure we will go into that direction. Firm reapportionment is clearly not on the agenda of the OECD. I'm not sure it's on the agenda of any organization, not even the UN, but it's clearly discussed by economists and civil society and other practitioners. But for the time being, the focus is on the right use of CbCR, and how can tax administration do the risk assessment properly and then use this information, not to do audits immediately or do the adjustment, but focus the attention and then do the right audits based on that information. So that's risk assessment. And then in the transfer pricing area, beyond what Jeff has explained on the financial transaction, which is left of the BEPS project, it's more about how could we incorporate changes to transfer pricing rules in the context of the tax challenges of the digitalization of the economy? In other words, if there is a solution going beyond digital, which is one of the options which will be discussed and which has been discussed, as you know, then there may be consequences on transfer pricing. And that's where I would invite you all to stay tuned, to look at our website, maybe to tune in our next webcast, which we could plan around January, if, as some of us would hope for or expect, there would be something emerging in terms of agreement of countries working together towards a solution to address the tax challenges of the digitalization of the economy. On that note, 3 minutes before the plan ends, I suggest that we leave you there. You are welcome to send comments. Are these webcasts useful? We haven't been present for some time, but we thought that we didn't necessarily have much to say. There has been a lot of work in the background to prepare. We were happy to give you the latest update on the implementation of the BEPS standard, in particular harmful tax practices, and the meeting is going on right now on CBI and RBI, residence by investment, citizenship by investment, where it was news today. Mutual agreement procedures is still going on. It's hard work. The MLI is doing pretty well, with more countries joining and signing soon, so more entry into force, more changes to the existing rules. So on that note, I would like to thank you all very much for listening to us, and I look forward to having the next webcast soon, probably in the new year. By then, please look at our website, and we'll try to feed you with as much as we can. Thank you very much, and thanks for the team to have joined me for this webcast. Thank you.